Chapter 8, Individual Income Tax Computation and Tax Credits. So these are just a few of the items that go into computing regular taxes for individuals. And we've talked about these characteristics already, but when we talk about the actual tax computation, these are some of the things that we want to take into consideration first. Now, you generally hear the term tax bracket reflecting whichever band of income tax percentage that you are ending up paying. We already talked a little bit about the progressive nature of our income tax system. So really, if you're in the 35% bracket, that doesn't mean that all your income's taxed at 35%. It just means that you've already gone all the way up through the 10%, the 15%, the 25%, the 28%, and the 33% components of the tax. And each next dollar that you make right now is within the 35% bracket. Being married, typically you hear that married filing jointly is the best status that you can have. If that is generally a pretty good generalization to make, but as this particular bullet point in this slide points out, there are situations where being married can actually hurt at least one of the spouses. So if you look at these situations here, if you are in a situation where only one spouse receives income, or one spouse receives a significant amount more than the other spouse in income, that's a situation where being married would definitely help your tax status, because obviously adding one person's non-earnings and combining that with someone else who earns is almost like dividing that other income in two. So for tax purposes, using up some of that lower taxed income to make up for the other spouse not working ends up benefiting you more tax-wise than a situation where both spouses are working already and receiving income. Now the brackets that we looked at in the previous slide were the ordinary tax rate brackets, but we do have some exceptions to those brackets, which we've talked about at least a little bit. Long-term capital gains, the net capital gains when we combine long-term capital gains and capital losses, whatever the net capital gains are, depending on what your ordinary income tax bracket is. These are generally taxed at either non-taxed at 0% or at 15% or 20%. Again, as I said, that is dependent on what your ordinary income tax bracket is. And there's a possibility that depending on how much gain you have, you could have more than one tax rate on the same gain. Dividends, qualified dividends, I should say, are generally taxed at either the 0, 15, or 20%, similar to the first three components of the long-term capital gains. And again, depending on the size and situation of the dividend payment, there is a possibility that two different tax rates on the same dividend income could be possible. So this is just an example. Assume that Courtney's taxable income is $451,000, including $15,000 of qualifying dividends taxed at the preferential rate. What would be Courtney's tax liability under these circumstances? Well, let's take a look at that. So if you just skip to the answer there, $126,936. We're using the head of household filing status here. Got your taxable income, $451,000, $15,000 of preferentially taxed income. How much of that income is taxed at ordinary rates? Well, that would just be 1 minus 2. What's the tax on income at ordinary rates? You're just going to take the amount there and multiply times 35%. And if you look at the tax rate schedule, you'll see how that computation plays out. But that's the result of it there. The 15% tax rate on the first $5,000 and the 10% tax rate on the 20% tax rate on the next $10,000 make up our tax on preferentially taxed income, and we add those together and that gives us our total tax. There's also a net investment tax, which is a 3.8% tax imposed on the lesser of these two amounts, either your net investment income, which the examples of that you see there, or the excess of modified adjusted gross income over $250,000, assuming married filing jointly status, or $125,000 for married filing separately, or $200,000 for all other statuses. And you're just taking the 3.8% tax on the lesser of those two computations. Now, kiddie tax is the federal government's answer to trying to shift, parents trying to shift investment income to their kids who are taxed at a lower rate. So any net unearned income of a child is generally going to, because of the kiddie tax, be taxed at the parent's marginal rate. So that means whichever bracket the next dollar earned in your parents' tax bracket is. So if they've already reached up into the 35% bracket, that means that all of this supposed kiddie investment income would be taxed at that 35% rate. So obviously that's a pretty big disincentive to try to do that. And this applies if any of those situations exist there, age-wise. So kiddie tax example, suppose that during 2016, Darren received $1,100 in interest from an IBM bond, and he received another $2,200 in interest income from a money market account that his parents have been contributing to over the years. What is Darren's taxable income and corresponding tax liability? Darren's mother, Courtney, is subject to a 25% marginal tax rate. So because he is less than 18 years old at the end of the year and his net income exceeds $2,100, he could potentially be subject to the kiddie tax computation. So that's what we would do here. This shows you what that computation is. $25% is parents' marginal income, and you see after we go through all of the calculations down there that the total tax liability for Darren is $405. Alternative minimum tax is the federal government's attempt to make sure that no one is able to game the system such that they avoid paying some minimal amount of tax. Now, if you recall from the last election cycle, when there was a big uproar about Mitt Romney's tax status and his overall effective tax rate, that should show you that given the proper motivation and financing, it is still possible to get your effective tax rate at an even lower rate than is allowed for under the AMT. But what ends up happening is there are certain deductions that get added back in to calculate the AMT. So after a while, you get, once you start doing taxes, you will get kind of accustomed to seeing what those particular deductions are and be able to red flag that whenever you see it and think to yourself, hey, I may need to do an alternative minimum tax calculation for this individual because they have these particular deductions that would trigger it. At any rate, this is the textbook definition for computing the alternative minimum tax. So, obviously personal independency exemptions, that's not really going to really affect you too much. A lot of real property taxes, home equity loan interest, and sizable miscellaneous itemized deduction could all be red flags. Meaning that if you have a lot of your deductions, or if you have a lot of deductions in general, and then a lot of those deductions come from these sources, those would be indicators that you potentially should be looking at alternative minimum tax. So based on that, there is a phase out to certain portions of the alternative minimum tax, and depending on your status, you have a certain amount of income that is automatically exempt from that. So we already talked about that a little bit. If you have anything that makes up a lot of what's getting you out of your tax liability comes from those sources that we talked about here, that is an indicator that there's a likelihood that you would owe alternative minimum tax. So this just indicates that that alternative minimum tax ends up happening a lot more than it used to, and the reason why. These are the FICA taxes here, which would be your Social Security and Medicare taxes. Those are the rates that apply. Remember, as a self-employed individual, you end up having to kind of double dip on a lot of these taxes, where you end up being responsible for the employee and the employer portion, but there are some corresponding deductions applicable to that, as we've already talked about a little bit. I guess I should have just waited for that slide to talk about that, but yeah, just remember that as a self-employed taxpayer, you could be responsible for the entire FICA tax. So assume that Courtney received $100,000 of taxable compensation from EWD. In 2016, she received $180,000 in self-employment income from her weekend consulting activities. What amount of self-employment taxes is Courtney required to pay on her $180,000 of business income? Assume that Courtney's employer correctly withheld $6,200 of Social Security tax, $1,450 of Medicare tax, and $0 of 0.9% additional Medicare tax. So we'll go through these item by item here. You've got, well, you can just take a look at that chart there. Let me know if you have any questions on how those calculations come out. We'll move on from there. So determining whether you qualify as an employee or an independent contractor could be pretty important in determining which taxes you are responsible for. This also can or does, I should say, make a difference as far as the deductibility of business expenses goes. If you're an independent contractor, that basically means you're self-employed, in which case you may owe, or you would owe, the employer a portion of the self-employment taxes, but all of your business expenses would be for AGI expenses instead of from AGI expenses. Tax credits come in these three different flavors, and the difference between a tax credit and a deduction is that tax credits reduce tax liability dollar for dollar, whereas a tax deduction simply reduces the taxable income by $1, which at most would reduce the tax by just under 40%. On the non-refundable personal credit category, the common types, or I should say the only types, but the most common is the child tax credit. It's $1,000 for each qualifying child under the age of 17 at the end of the year. Partially refundable in certain situations, but it does phase out at varying income levels. The other one, child independent care credit, is only for expenditures that qualify as being for child independent care. And that tells you what percentage that could be. Other non-refundable personal, the American Opportunity Credit, these are based on higher education costs. That's just a continuation there, an example, you can take a look at that. The key to the American Opportunity Credit is making sure that the income is not too high and any costs that it would be used for are qualified costs under the definition there. So there's an example of all the various factors that go into that in our particular example, where the answer of what was available under that credit is $1,867. We've got the lifetime learning credit, which is a less extensive credit for higher education expenses. This one does include professional or graduate school, so it's a little bit different in how it functions. Again, it phases out based on AGI and has a maximum benefit of $2,000. Then we move on to the refundable personal credit category. Obviously, earned income credit is pretty much the biggest tax credit that is refundable and ends up paying out to lower income people. You have to have a certain amount of earned income, but as long as you meet that bottom threshold and are not over the upper limits of income threshold, this basically just means that you have a negative income tax and you are actually paid basically paid a tax by the United States government to you to help subsidize your income. Those are some of the qualifications there. Again, these are pretty low income individuals. The purpose of, we've talked about this before, but the purpose of certain business tax credits are generally to encourage, for policy reasons, certain behaviors. So, a lot of those are just to generally encourage commerce, or specifically to encourage a certain type of commerce. So I think we talked about this a little bit already, but most people who have only worked at jobs where they have income tax withheld don't always realize that although tax day is April 15th, that doesn't mean that that's the first time during the year that taxes are due. Now, if you have money withheld from your paycheck, each paycheck, then the IRS treats that as if you're paying equal installments throughout the year of your owed tax, so it's not a big deal. But if you end up as a self-employed individual or an independent contractor, what have you, where you are not having your withholdings coming out of your checks before they come to you, then you're required to make quarterly tax payments based on an estimate of what you believe your tax liability to be at the end of the year. So if you fall in that category, the April 15th deadline is only the deadline for the fourth payment, and basically the deadline for filing the final, assuming you didn't get an extension, but filing the final paperwork that justifies what your estimate was, or says, hey, this is a correction to the estimate, and I either owe more money or should get some of the money that I paid back. So as long as you pay 90% of your current tax liability in those estimated payments, then you're fine. The other possibility is you can pay 100% of your previous year's tax liability in order to guarantee that you're not going to owe some penalty for not paying enough during those estimates. So obviously, if you have money that's being withheld from your paycheck, you don't have to worry about this unless you've reported a whole lot more exemptions than you really should get, and have not had them withhold enough money for you. But assuming that you filed your W-2 forms correctly, and there, the proper number of exemptions and the withholdings are correct, then you don't have to worry about making an adequate amount of payments because that's automatically done for you. So these are the situations where you have to file a return, and of course you are able to file a return regardless of what your income is, if you so choose. And I will say that since there are a lot of different things that require or go off your tax return, like doing the FAFSA and stuff like that, or that's one of many things that uses your tax return, I would recommend everyone to file a tax return each year. So, just because you're a student and you're not making a lot of money, even if you have a part-time job and you're under the threshold to file, I would still go ahead and file, just because once you have that on file, if there's ever a need to look at your taxes, pull them up, if that's a question for doing the FAFSA or whatever else that you need to do for graduate school or whatever, it's a whole lot easier to have just already done it and not have to go through the hassle of trying to file late and all that kind of stuff. So you're able to automatically extend, assuming you meet the deadline, for up to 6 months. So a lot of people will say, oh, I'm just filing an extension. But some people don't realize that the extension is only for actually filing the paperwork. That does not excuse you from paying any taxes that might be due. So all of your taxes are due by April 15th. Just because you haven't went ahead and filed the final return does not stop the running of the clock for any potential penalties for not paying enough or not paying a timely income tax. Those are some ideas of what the fines can end up being for late filing and late payment. So obviously those are separate issues. Late payment occurs anytime after April 15th. Late filing is, assuming you filed an extension, it could be 6 months later, or if you didn't file an extension, anytime after the 15th of April. So you can take a look at that final example there. And that's it for this chapter.